The number 40, 50,000 is based not on commercial bank money and not on the M2. The M2 is base money plus all the loans that are made piled on top of it. Just talking about the monetary base. The monetary base itself is the balance sheet and all the assets on the balance sheet. And then you have a little bit of gold, 235 million ounces, the unaudited, whatever. Let's just assume it's there. So if we were to take the monetary base and take all the value of that in dollars, and then the tiny amount of gold it has on its balance sheet, 235 million ounces, if we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something.
The global financial system is heading into uncharted waters. Debt levels in the United States have exploded, interest rates are trapped, and faith in the dollar's long-term stability is hanging by a thread. For decades, the world has treated the U.S. currency as the ultimate safe haven, but that trust is quickly evaporating. The reality, according to financial analyst Rafi Farber, is that a breaking point is near, and when it arrives, the revaluation of gold will not be optional, it will be unavoidable. Farber warns that what is coming is not just another cyclical downturn or temporary banking crisis, but a fundamental reset of how value is measured. In his analysis, the dollar itself is merely a derivative of gold, not the other way around. That means every fluctuation in the price of gold is really a revaluation of the dollar, a fact that most investors overlook. And when the system finally acknowledges this reality, gold will need to be repriced dramatically higher to restore any credibility to the Federal Reserve's balance sheet. How high? Farber calculates that the monetary base, compared to the tiny amount of gold still held by the U.S. Treasury, implies a fair value for gold between $40,000 and $50,000 per ounce. Numbers that sound outrageous to the uninitiated are, in fact, grounded in historical precedent. Just as in 1933 under FDR, and again in 1980 when the free market forced revaluation, the coming crisis will require gold to once again play its role as the foundation of money. And when that happens, silver, often overlooked but historically far more explosive, could deliver even greater relative gains. In today's video, we'll hear directly from Rafi Farber as he explains why the dollar's credibility is collapsing, how a gold revaluation is inevitable, and why investors need to understand the consequences before it's too late. Stay tuned, because this is not speculation. It is a repeat of history playing out in real time. And before we dive in, make sure to hit that like button, subscribe if you haven't already, and turn on notifications so you never miss critical insights like these. We appreciate the support and hope you enjoy the video.
I want to talk about this in the context of course, gold being money and the dollar only being a derivative of it. And that's always hard. I keep going back to that because that's the number one message, but it's hard to keep it in your head and to take it seriously. Like people treat it like, oh, it's just a religious statement, like, God is one, whatever, but you don't really know what that means. But you have to understand what it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, I was reading one of Glenn Beck's books, decide if he's the path I wanted to go on. Ultimately, no, it wasn't. He was an influence, but I never really went down his path. But he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right? They're brought about in different ways, and that's but they are monetarily speaking, what is happening in the monetary system. It's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it if it was like, say, a meteor from God, or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. But in 1980, it was by the market itself, when the market decided that the other stuff on the Fed's balance sheet was not trustworthy. So it rose, it bid up the value of the gold to back the rest of the assets on the Fed's balance sheet, which is mostly debt, to 100%. And that made the rest of the debt trustworthy. Now the question is, what percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people? And if we go to the 1980 numbers, it's something like $40,000 to $50,000. So think of that number and they're like, oh, this guy's a crazy gold bug. But it happened before. And once it happens, I'm going to get rid of my gold. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things. And I'm going to call it the end of this game. I'm going to move on with my life. And we'll see what I do after that. But I know where the bell is, because we've had 1980, so that's what I'm waiting for.
You know, that $40,000 per ounce, that's based on kind of the relative valuations of other items as well, or the monetary, how many dollars there actually are out in existence at the moment?
It's not dollars. There are different kinds of dollars out in existence, right? There's the monetary base, which is the stuff that's on the Fed's balance sheet. Like when the Fed buys an asset, it creates new dollars and gives them to whoever gave them the asset. Those are that's base dollars. And then you have commercial bank deposits, which are created through loans and other activities, which are built upon that base. So the number 40, 50,000 is based not on commercial bank money and not on the M2. The M2 is base money plus all the loans that are made piled on top of it. Just talking about the monetary base. The monetary base itself is the balance sheet, and all the assets on the balance sheet. And then you have a little bit of gold, 235 million ounces, the unaudited, whatever. Let's just assume it's there. So if we were to take the monetary base and take all the value of that in dollars, and then the tiny amount of gold it has on its balance sheet, 235 million ounces, if we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there. To cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that. So that's the calculation.
But it sounds like it maybe could be used as an excuse to create more currency, or to go further into debt at that point. So it doesn't seem like it would be a way to get the government's fiscal situation under control.
Right. There is no getting the government's fiscal situation under control without destroying the banking system. You know, the government, it's hard to say how much they believe in what they're saying, these position papers, and how much is propaganda and how much they're just making it up. I don't know. But the way that they're thinking about it, they say, look, we have this gold. It's not really 42. If we just stop lying, then we have all this free money and we don't have to raise taxes and we don't have to increase the debt. It seems like free money, right? How could you go wrong? And if you don't understand that gold is money, and if you revalue the gold dollar ratio, you're not changing what money is, you're changing what the dollar is. And if you change what the dollar is, that affects all prices down the line very quickly, not overnight, but within, months. When FDR did it, it was a 66% revaluation. It took about a year to get to maximum price, consumer price inflation. I don't think anyone in the government understands that gold is the money right now. And because they don't understand that, they see this as like a mathematical trick that can just, give them manna from heaven, free money. And they say like, why don't we just do that? And then the only reason they don't, I think, is because maybe there's some traditionalist people, or maybe they don't fully buy into their voodoo. And they're like, maybe this is not such a good idea. It's like Louis C.K.'s famous comedy bit, of course, but maybe, of course, free money is great, but maybe destroying the dollar isn't such a good idea. They're not sure about it. So we'll see what they do. And if they don't do it, the market's going to do it anyway.
What Farber makes clear is that statutory revaluations, like Roosevelt's in the 1930s, and market-driven revaluations, like the 1980 gold spike, are functionally the same thing. Both strip purchasing power from the dollar while restoring confidence in debt markets temporarily. Whether by decree or by free market pressure, the outcome is inflation, a redistribution of wealth, and a reminder that gold is the true anchor of the system. Today, the same mechanics are in motion again, and Farber believes the market will not wait for policymakers to act. But this time, the Federal Reserve is backed into a corner with no good options. If it cuts rates while consumer prices are still accelerating, it risks outright hyperinflation. If it refuses to cut, the fragile banking system could collapse under its own weight. As Farber explains, this is no longer about preventing a recession. It is about choosing whether to sacrifice the banks or sacrifice the currency. In the next section, he outlines why this dangerous juggling act, combined with political maneuvers like the so-called Genius Act and the rise of stablecoins, cannot change the underlying reality. The pyramid of debt still rests on gold at the bottom, and when the cracks spread, the entire structure shakes.
When we start playing the inflationary game, you are playing the game of the currency versus the banks. You can save one but not the other. And now as you go up the pyramid, you can juggle, right? So as we go up the pyramid, this pyramid, let's say it started in 1933 with that initial revaluation, then you can juggle that pyramid and only hike when price inflation goes higher, when consumer prices go higher faster, and cut only when they stop accelerating as fast. And the reason you can keep juggling is because of the analogy that I often use, the apple tree, the orange tree in your backyard, right? If you have incredible production, you don't notice that your neighbor is stealing from you. But if your neighbor invites his cronies to his your backdoor neighbor, and they want to eat more and more and more oranges, which is the equivalent of the government growing bigger and bigger and bigger, because that's how it always happens, then you can keep consumer prices lower by increasing productivity. But there's a point where you can't increase productivity any longer, and you're overburdening the slaves, and they can't make the tree any more productive. So at that point you have to start cutting into an accelerating consumer prices environment, which is where the Federal Reserve is headed now, because this is what just happened like a week or two ago, right? They were urging Powell the Trump administration was urging Powell to cut, and he was saying, he hinted no, he's not going to do it because consumer prices are rising too fast. And then he came out in Jackson Hole and said, well, we're going to cut now. And then gold and silver jumped. Consumer prices are rising faster than at any time from 1980 to just before COVID. So they're going to be cutting into a higher consumer price environment, and that means they will destroy the currency. Until now, they've always only cut into what they call recessions, when consumer prices stop rising and you have this huge banking crisis. So you can pick, I'll save the banks, and the currency will level out in consumer prices. But now they can either trigger hyperinflation by cutting to zero in an environment of very fast rising prices, or they can not cut at all and let the banks fall, and then everything goes with it, and all prices fall, consumer prices too, but they fall the slowest compared to everything else, including assets like stocks, bonds, Bitcoin, all those other things. Consumer prices still fall, but however it goes, it doesn't make a difference for gold and silver holders because all the purchasing power goes into those metals anyway.
What is your view on the Genius Act, and could it be an option for the government to kind of replace the current monetary system with?
No, it's not going to replace anything. All it's got, we're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins, fine. I don't dispute that at all. And I know that the government wants to take as much liberty as they can from us, reasonably, as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. What the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later, there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time, when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it and then it just falls over anyway.
While, the end game could be very destructive and hurt in a lot of ways, coming out of it, it seems like you have a very hopeful view.
I do have a very hopeful view. I think we're going to be fine. Not everyone. I think a lot of people that have no idea not only what money is, most people don't know what money is, and that's okay. You don't have to know. But most people who don't know what human interaction is, don't know what community is, don't know what faith is, don't know what morality is, and there's a lot more of those people in the big cities, they're going to be in a lot of trouble spiritually, mentally, physically, and all that. The people that have a general idea of what it is to be human, they'll do a lot better. And I think there's more of us than we think there are. A lot of them they're not interested in gold and silver, but it doesn't mean they don't understand a lot more. And once they see that gold and silver are rising and the purchasing power is going into them, they'll follow and they'll be fine and we'll be fine. And it's going to be rough. Not everyone is going to survive, but those that do are going to make this world a much better place, and I'm looking forward to it.
Rafi Farber's analysis underscores a stark reality. The U.S. monetary system has reached a tipping point. With the Federal Reserve's balance sheet already stretched to extremes and inflation running far above historical norms, the central bank is trapped. Raising rates aggressively risks detonating the $33+ trillion debt bubble, while pausing or cutting would reignite inflation and accelerate the loss of faith in the dollar. Either way, the confidence game that has underpinned the dollar for decades is unraveling, and once trust is gone, history tells us it doesn't return. Gold and silver are already beginning to signal this transition. Gold's trajectory in recent years has diverged sharply from the official inflation numbers, suggesting that the metal is silently pricing in systemic stress. Silver, meanwhile, remains historically undervalued, trading at a ratio to gold that is wildly out of line with both its industrial necessity and its centuries-long monetary history. If the gold-to-silver ratio simply reverts to historical norms, silver's price would not just double or triple, but potentially rise tenfold from current levels. This imbalance is not sustainable, and when the adjustment comes, it will be violent. Farber's estimate that gold's fair value could approach $50,000 per ounce based on the current monetary base is not a sensational forecast, but a mathematical calculation. When governments destroy their currencies, markets eventually re-anchor to real money, and the sheer volume of paper claims outstanding means the revaluation of gold and silver will need to be astronomical to restore equilibrium. Those who dismiss such numbers as fantasy are ignoring monetary history, whether it was Weimar Germany, 1970s America, or more recently, Argentina and Turkey. Fiat systems always collapse under the weight of excess. The only question is when. The opportunity, however, is not open-ended. Once confidence breaks, markets move at lightning speed. By the time the mainstream begins rushing into metals, supply will dry up, premiums will explode, and average investors will be locked out. We're already seeing hints of this as sovereigns, central banks, and billionaires quietly accumulate physical gold and silver, while retail remains largely absent. This widening gap between smart money and the general public is the final warning shot before the repricing begins in earnest. The message is clear. Those who prepare now will be on the right side of history when the system resets. Gold and silver are not just hedges, they are lifeboats in a storm the central banks themselves have unleashed. If you found this breakdown valuable, hit the like button, share your thoughts in the comments, and subscribe so you don't miss our next deep dive into the unfolding monetary crisis. Until then, stay informed, stay prepared, and above all, keep stacking. Thanks for watching.